Have you noticed the recent trends in the stock market? It has been a roller coaster of events. Over the last week, we've seen significant shifts and movements that have kept traders on their toes. From the S&P 500, NASDAQ, and Dow posting total returns of over 2% for the third week in a row, to the US inflation rate moderating in October. We've also seen oil prices experiencing their fourth weekly decline, with volatility throughout the week. And let's not forget China's monthly growth in industrial output and retail sales. It certainly has been a week full of surprises, so buckle up and let's delve into the specifics of each day's market activity. Kicking off the week, Monday saw a surge in US stock indexes. The S&P 500, NASDAQ, and Dow Jones Industrial Average all posted impressive total returns of more than 2%. This marks the third week in a row that these indexes have managed to maintain this positive momentum. Each of these key indicators was driven by a variety of factors, from better-than-expected monthly inflation reports, sparking stock market rallies, to a drop in the yield of the 10-year U.S. Treasury bond following a lower-than-expected inflation reading. Monday set a positive tone for the week, but what happened next? As we moved into midweek, we saw some interesting developments in the market. The excitement kicked off with a better-than-expected monthly inflation report that sparked a stock market rally. This positive news sent shockwaves through the trading floor, with U.S. stock indexes including the S&P 500, NASDAQ, and Dow posting total returns of more than 2% for the third week in a row. In the midst of this, the yield of the 10-year U.S. Treasury bond took an unexpected nosedive. The drop came as a surprise, following a lower-than-expected inflation reading. This shift added another layer of complexity to an already dynamic market landscape. To add a bit of spice to the midweek madness, oil prices took us on a roller coaster ride. We experienced the fourth weekly decline, with volatility keeping traders on their toes throughout the week. And while all this was happening, China reported monthly growth in industrial output and retail sales, adding an international flavor to our midweek mix. Midweek left traders on their toes. Let's see how the week ended. Closing out the week, we saw some surprising shifts in the market. U.S. retail sales slipped a fraction of a percent in October compared to the same month a year earlier. This subtle drop might seem insignificant, but in the grand scheme of things, it's a reflection of a changing consumer landscape. On the other side of the globe, China reported monthly growth in both industrial output and retail sales, showing resilience in the face of global economic challenges. These developments are a testament to China's economic prowess, and could signal potential investment opportunities for the keen-eyed trader. Back home, the SIBO Volatility Index, a barometer of investor sentiment and market volatility, fell for the fourth week in a row. This consistent decline suggests that traders are feeling more confident and less uncertain about the market's trajectory, which could lead to a more stable trading environment. That wraps up the week's major market events, but what do these developments mean for traders? The week's market events have brought some key takeaways for traders. Let's delve into the implications of these developments and discuss potential strategies that you might consider. Firstly, the U.S. stock indexes, including the S&P 500, NASDAQ, and Dow, posted total returns of more than 2% for the third week in a row. This consistent performance shows resilience in the face of various market forces. It's a reminder that a well-diversified portfolio, with a healthy mix of large-cap stocks, can provide stability and growth over time. Secondly, U.S. inflation continued to moderate in October, with the core rate rising at the slowest annual pace since September of last year. This easing inflation could provide some breathing room for the Federal Reserve and might delay any potential interest rate hikes, which is generally a positive for equities. Next, oil prices experienced their fourth weekly decline, indicating potential volatility in the energy sector. Traders might want to keep a close eye on this sector, as changes in oil prices can have significant ripple effects across the economy. Meanwhile, China reported monthly growth in industrial output and retail sales. This suggests that the world's second-largest economy remains robust, which could have positive implications for international equities and commodities. Finally, the SIBO Volatility Index, or VIX, fell for the fourth week in a row. This index tracks investors' expectations of short-term U.S. stock market volatility. A decreasing VIX typically indicates increasing investor confidence and can be a positive sign for equity markets. In light of these developments, traders might consider reassessing their portfolio balance, paying particular attention to sectors affected by these market movements. Remember, diversification and a keen eye on market trends are essential tools for navigating the ever-changing landscape of the stock market. Remember, the stock market is a dynamic entity, and staying informed is the key to success. Until next week's recap, happy trading.